now what we are talking about in the secondary market, how you can buy or sell a particular stock. So you have to make certain decisions while deciding about which stock you have to buy. After doing all the research, after doing all fundamental research, technical research, everything you are committed that you have to buy that particular stock. Then you will come to a point where you have made a decision to trade. So what you have to decide? You have to decide the name of the stock, in which stock you have to trade. So you have to decide the name of the stock and whether that stock is listed on NSE or BSE. Let's assume that it is listed on NSE. So you have decided to buy a stock, this stock, which is listed on BSE as well as NSE, but due to the liquidity part, you have selected a particular stock exchanges, or you have got there at a price cheaper than BSE. Okay, so you have selected a stock which is listed on NSE. Then the type of trade. Now there are two types of trade that you can put. Either you can put cash to carry, that is called as cash stock, or you can do an intraday trading. Now I talk about cash to carry. Cash to carry means a stock where you want for a longer term perspective. That means you want to carry that trade over a period of time. It can be 1 day, it can be 2 days, it can be 3 days. Means today you are trading, assuming 16th April. So today you are trading a particular stock and you want to carry it till tomorrow. Then you have to place a cash trade, which is called to be a CNC order. Okay, you have to put an order of cash to carry trade, where you can sell that particular stock. Okay, at the you can particularly, if you are buying today, you can sell that particular stock to or over a period of time. But you cannot sell a stock. If you are buying a stock today, you cannot sell a stock today itself. So in that case, if you want to buy a stock and sell it today itself, then you have to do an intraday trade. Okay, but if you want to hold that particular stock, you have to place an order called as CNC. Now in both these cases, the margins are different. You have to pay different margins for cash to carry trades. You have to pay a different margins for intraday trades. Margins means the money that you are paying for a trade. Okay, the money that will be debited from your account for buying a trade. So if you are trading for a cash to carry, you have to pay 100% margin. So if a particular stock is at rupees 100, you have to pay the entire 100 rupees as a margin for trade. But if you are trading as an intraday trade, you have to pay only 100. If the stock is of 100 rupees, you have to pay only rupees 20, because you know that the stock will not move beyond that, because every stock has a circuits. So each stock will have its own margin. Now margins will be decided. Each stock will have different margin. For intraday trades, each stock will have different amount of money that you are required to pay. Will depend upon the risk. There are various factors that will determine what amount of margins you are required to pay on that stock for that particular trading purpose. So each stock will have different margins for intraday trades. So if you are buying for a 100 rupees stock, you have to just pay 10 rupees or 20 rupees for that particular stock if you want to do an intraday trading. So for intraday trading, you have to pay just lower margins, but the risk is also high. Whereas in case of cash and carry trades, you have to pay 100% margin. So if you are buying a 100 rupees stock, you have to pay entire 100 rupees. But for intraday, you have to just pay 20 rupees or 30 rupees or 10 rupees. Depends on the securities in which you are trading. So there is a different altogether. So if you are an intraday trader, if you like to take risk, then you can do an intraday trade because the margins are lower. In cash to carry, the margin is required to pay an entire 100 rupees. Then you have to decide. So you have to decide which type of trade you are required to take in the market. Then the third one is a quantity. How much quantity you are required to enter. So if you are decided to take 100 quantity or 10 quantity or 20 quantity of a particular securities, so you have to decide that how much quantity are required to take. So you have to manually put that amount of order quantity. So in the order quantity field, you have to put an order quantity, and based on that the trade will execute. And fourth very important is price. At what price you have to place an order. of that particular security. Now there are two different ways in which you have to place an order and price for a price. So you can place an order through limit price, or you can place an order through a market price. Now what is limit price? So when you say limit price means you will manually enter a price at which you want to enter into a stock. Say for example, the stock now currently trades at 100 rupees. Okay, and now you want to buy that stock at 98. You're bargaining, right? So in the limit price, you're bargaining to buy a stock. Definitely, if you're a buyer, you will bargain for buying at a lower price. So if a stock is trading at 100 rupees, you will buy a stock. If you will put a limit price at rupees 98. That means I want to buy a stock, let's say 20 quantity at 98 rupees. Now currently the stock is running at 100 rupees, and you have to buy at 98 rupees. Then you have to place a limit price order at 98. 20 quantity at 98 rupees. Now once this price will cross to 98, your order will get executed into a trade. That means you have bought a share of 20 quantity at 98 rupees.